Tax and Compliance for Hustlers. Episode 1. The 280E and the Side Hustler. What you need to know. Stay legit. Secure the bag. Scale your hustle. This series tackles the nitty-gritty of taxes, legal compliance, and financial strategies for hustlers and small business owners. It's your ultimate roadmap to navigating the complexities of entrepreneurship, scaling legally, and protecting your paper. Before we dive in, make sure to hit that like button and subscribe. Your support helps us reach more hustlers like you. Taxes can make or break your hustle, and if there's one part of the tax code that can trip up entrepreneurs in certain industries, it's Section 280E. This tricky little section has huge implications for side hustlers, especially if you're in industries like cannabis, CBD, or anything remotely connected to federally controlled substances. But let me be clear, this isn't about fear. It's about empowerment. You can navigate this law and still build a successful business. Welcome to Taxes and Compliance for Hustlers. Today, we're breaking down Section 280E. What it is, how it works, who it affects, and what you can do to stay compliant while scaling your side hustle. Let's make sure your hustle is smart, secure, and built to thrive. Part 1. What is Section 280E? To truly understand 280E, you need to know where it came from and how it's being applied today. Let's start with the basics. 1. The history of 280E. Section 280E became law in 1982, aimed at illegal drug trafficking. It was designed to ensure that no one involved in the trafficking of controlled substances could deduct ordinary business expenses on their federal taxes. For example, if someone was selling Schedule I substances like heroin or cocaine, Congress didn't want them writing off expenses like rent or wages. Fair enough, right? Fast forward to today, and here's the issue. Some state legal businesses, like cannabis dispensaries, or those selling CBD derived from cannabis, are now caught in the crossfire because cannabis remains a Schedule I controlled substance under federal law. 2. What does 280E actually mean? 280E means that if your business is involved in the trafficking of federally controlled substances, you can't deduct most ordinary business expenses on your federal taxes. But here's the twist. You can still deduct the cost of goods sold, or COGS. Cost of goods, sold, or COGS. This includes direct costs like raw materials, production, and inventory expenses. It's the one area where 280E offers some relief. Non-deductible expenses. Rent, utilities, wages, marketing, and just about everything else are off limits for deductions under 280E. This creates a unique challenge for businesses, but it's one you can navigate with the right knowledge and support. Want exclusive tips and resources to stay compliant and scale your hustle? Sign up for our free newsletter in the description below. Part 2. Does 280E affect you? Now you might be thinking, does this even apply to me? If you're involved in certain industries, either directly or indirectly, 280E could absolutely affect you. Here's how to know. 1. Directly impacted hustles. The most obvious businesses impacted by 280E are cannabis dispensaries, even in states where cannabis is legal, but it doesn't stop there. If you're selling CBD products derived from cannabis rather than hemp, you might be on the IRS's radar. Even side hustlers running small-scale cannabis or CBD operations need to be aware of these rules. 2. Indirect impact for related businesses. Here's where it gets tricky. Even if you're not directly selling cannabis, 280E can apply if you're supporting or servicing businesses in those industries. Examples: landlords renting to cannabis businesses. Marketing agencies or consultants working exclusively with cannabis clients. If there's even a hint that your business touches federally controlled substances, it's better to be informed than caught off guard. Part 3. Filing and compliance strategies. So now you know what 280E is and whether it might apply to you. Let's talk about what you can do to protect your hustle and stay compliant. First, track everything. Record keeping is your best friend. Keep detailed records of every expense, what it was for, how it relates to your business, and why it might qualify as COGS. Apps like QuickBooks or Expensify make this process easier. Separate personal and business finances completely. If you're audited, having a clear paper trail will be a lifesaver. 2. File accurately. When it comes to filing, accuracy is everything. Misclassifying expenses or underreporting income is a surefire way to attract the IRS's attention. Work with a tax professional who understands 280E and similar laws. Third, plan for the tax burden. Because 280E limits your deductions, you'll likely owe more in taxes than businesses in other industries. Plan ahead by setting aside a portion of your profits each month for your tax bill. Being proactive today can save you major headaches and money down the line. In closing, Section 280E is one of the trickiest parts of the tax code, but it doesn't have to stop you from building something incredible. With the right knowledge, tools, and strategies, you can navigate this challenge, protect your hustle, and scale with confidence. Drop a comment below with your biggest tax struggle as a hustler. Let's get the conversation going. Thank you for watching Taxes and Compliance for Hustlers. If this episode gave you clarity, hit like, subscribe, and share it with someone who needs to hear this. Let's keep learning, growing, and winning together. See you in